Welcome, everyone. Really excited to have you here this week for the HAI Research Seminar. My name is Patrick Hines. I'm Senior Manager of Research Communities here at HAI. It has been a really wonderful sort of series of seminars. I'm ad-libbing a little bit for my normal notes because I'm just thrilled to see everyone here. I think we've really been able to touch upon a number of subjects over the past few weeks. Our audience really seems really excited about the content, and that continues this week as well. Because today I'm delighted to introduce Erik Altman. Dr. Altman is a computer architecture research scientist at IBM. And over the course of his career, he's been involved in a variety of activities, including, but certainly not limited to, the design of image recognition hardware, as well as other research in AI, hardware and software to decoy missiles, real-time automotive software, and designs for advanced IBM processor chips, including both servers and the cell processor made famous in Sony game system or consoles. Excuse me. Dr. Altman has also served as editor-in-chief of the IEEE Micro. He's been the chair of the Association for Computing Machineries, the ACM's Special Interest Group on Microarchitecture, the chair of ACM's SIG Governing Board, which comprises major disciplines across computing, and has also been the secretary-treasurer of ACM as well. In his seminar today, Dr. Altman will dive into the subject of IBM Synthetic Data Sets and use cases for SDS within financial services. We're really thrilled to have Dr. Altman with us here today and quite excited to learn more about IBM Synthetic Data Sets, their use cases, and where we go from here.
Great. Thank you very much, Patrick. Very kind and generous introduction, and I'm thrilled to be here, honored to be here in such an august place with so many seminal people, accomplishments, etc. So, as Patrick said, I'll be talking about IBM synthetic data sets, just as sort of a level set in addition to everything that Patrick just said. I'm from the IBM Watson Research Center, which is on the East Coast, a little bit north of New York City, not from the Alberton Research Center, a little bit down the road from here. I've been working on synthetic data, especially synthetic financial data, for several years, but as the introduction sort of suggested, my background is really in microarchitecture, compilers, really low-level GORPy stuff that, of course, is very important in things like GPUs and other accelerators to run all of this wonderful AI that we've got now. And certainly this work that I'll be talking about, I'm obviously up here presenting, but a lot of help and work and contributions from my colleagues, not just me. So to dive right into things, what are IBM synthetic data sets? And a little later I'll get into the why and the how, but let me start with the what. So these synthetic data sets are focused on financial sort of themes like credit cards, debit cards, gift cards, some sort of basically spending that people do. And there's also a lot of banking information, lists of accounts, whether it's bank accounts, checking accounts, mutual funds, that sort of thing, loan payments, bills, so a very broad variety of sort of banking activity. And then there's also homeowners insurance, and that gets very detailed. Actually, I think the most detailed of any of these three high-level categories, and their policies, and I'll describe more about that. There's information about the policy holders, and insurance companies certainly want to know a lot about the risk of both say the structure they're insuring and the person who owns that structure. And then, of course, the reason one has insurance is, unfortunately, sometimes one needs to make claims. So I'll talk about all of these things, how we generate what we think is realistic data, and then how, as Patrick indicated, how some of the ways we think are very important that it can be used. And so to create all of this data, we don't just sort of randomly populate fields like how much was spent randomly. We create a synthetic population and with lots of with synthetic people. I'll go into a lot of detail, but these are purely synthetic people. We didn't start with some non-anonymized list and figure out how to do differential privacy or other techniques to obscure it. These are purely synthetic people, and I'll describe how we do that as I go along. So there's lots and lots of detail about these synthetic people, as you can see on the slide here. Everything from good stuff like education and jobs to not so good things like drunk driving arrests, arson convictions, and so forth. And also, of course, given the stuff you see at the top of the slide, stuff on the sort of payment cards, bank accounts, et cetera, that people have. And so as I indicated, because these are fully synthetic people, not anonymized in any way, there's no PII. Well, if you just glanced at the data that we have, you might say it's full of PII, but it's all basically fake PII, which I think can be useful in various ways in itself. If you're trying to check if maybe you have a tool that looks for PII, our data can give you lots of stuff to see just how well your tool does. All of this data is also done with referential integrity. That's a fancy way in the synthetic data business of saying there are multiple tables, like all the stuff you see at the top, and lists of credit cards, list of transactions, all that sort of stuff. So everything can cross-link together. And so you can say, oh, this person's credit card transactions look interesting. What are they doing with their insurance? So you can, referential integrity says that you can cross-link and look at things, slice and dice basically in whatever way is most important to you as someone using the data. And this is all done finally with 100% accurate labels. And so to give away one of the punchlines, one of the key use cases for this is unfortunately crime and fraud. So it's important to be able to label the data, whether a particular transaction is involved in credit card fraud or money laundering or some other sort of scam. And the way we generate the data, we can provide these labels with 100% accuracy. And again, to give away another punchline, if you were lucky enough to get real data, which is almost impossible to get, real data does very poorly on these sort of labels because unfortunately so much of the bad stuff gets missed. So why did we build synthetic data sets? I thought I'd quote not just from myself and what really directly motivated us, but a VP at another large tech company who said, when it comes to the latest AI innovations, the first questions banks should ask themselves is how good their data is. And then getting data into a place where you can make a high quality data set is important for model accuracy. And that really summarizes what motivated us to do this, because there are all these problems, as I sort of alluded to on the previous slide, in terms of fraud and money laundering and other criminality. And so banks are anxious to do better at this, and IBM has its own motivations, as I'll get into. And so a key purpose in generating this data is not just to have the data for itself, it's to enable AI models to be able to detect all this bad stuff that's going on, and also some good stuff, I think. But unfortunately, a lot of the money in terms of what people will pay for in this space seems to be around bad stuff. And so continuing on the sort of theme of why we built IBM synthetic data sets, real financial data is almost impossible to obtain. I mean, if you're a large bank and you actually have transaction data, or an insurance company and you've got that sort of data, you don't want to give it out for really two key reasons. One is competitive advantage. You don't want your competitors to know, say, how your loans are doing or how much people actually hold in your accounts. And of course, even if they could give that out or didn't mind, there are huge privacy problems. So of course they're not going to do that. And so it's really almost impossible to get good data. And this actually reminds me, or sort of, I think, the inspiration Fei Li had with ImageNet going back a little while at this point. And there wasn't a lot of good labeled image data. And the fact that you were able to put that together here really revolutionized, and I think really kickstarted a lot of the modern AI effort and advances. And so at some level, we're hoping we can do a microcosm of that in the sort of financial data space. And I also want to underscore, so of course, things like LLMs do tremendously well on an amazingly broad set of activities, but this sort of data, like I say, real financial data is almost impossible to maintain. So you can't scrape the entire internet and everything else anyone's ever published and really get a good set of this data. So there are still important sets of data that are out there and are important monetarily and otherwise to people. And so this was a key motivation to us to try and overcome some of the problems there. And even if you were lucky enough, or you were working at one of these places that actually has real data, the real data has all sorts of problems, like I've said. By UN estimates and others, 95% of money laundering gets missed. So even if you've got real data, you don't really know what's good and bad. I just saw a report from the Federal Trade Commission here in the US a couple of weeks ago that said 90% of scams are not reported. Either people are embarrassed or they never realized they were scammed. And by scammed, I mean that unfortunately the fake bills you probably all get from Geek Squad, or fake romantic interest, or fake relative in distress, all the usual sort of stuff. Unfortunately, this is a huge problem, and for whatever reason, a lot of it does not get reported. And insurance claims fraud has been a problem for decades. And I think one of the key reasons, there are multiple reasons for that, but one is certainly that it's hard to detect. And if we can do better with models, I think that's a good thing. And I should say, just to back up a little bit, if you go back to, say, the year 2000 or 2005, banks and other places looking for this sort of activity basically had a set of rules. And so they would say, is this transaction at 3 in the morning in a strange place where this person isn't normally? Okay, that's a good likelihood of fraud. And that got them some amount of distance. But when they started doing really basic AI models like XGBoost or LightGBM, things improved a lot, because you could, of course, as with so many other things, understand a lot of the subtleties and interactions. And so I think there's still the problem with the poor data labeling, and with, I think, good quality synthetic data. I think that can potentially remove one of the big challenges. And now to jump down to the bottom part of the slide, global scope is often missing. So in places like the US, for example, banks can only see the transactions at which they play a role. So say JP Morgan has a transaction that's going to Citibank. Well, the two of them can see it, but Wells Fargo can't see it. And so for something like money laundering that not only crosses bank boundaries, but often international borders, that's very problematic, because you have this very narrow perspective on things. And so with synthetic data, you have an opportunity, if you do it right, to have a much broader scope, and I think improve on that situation. So all of these things were motivations to us to build what we hope is good quality synthetic data. And so just these things that I've just been talking about have implications. It's not just a bank is worried about money laundering, so they assign 2 people with low pay to go do something. No, big banks can employ 1,000 or more fairly highly trained people to investigate money laundering. They tend to, what happens is there's like an overnight screening, and the screening says these look suspicious, but 80 to 95% of those initially tagged transactions or problems are actually fine. So it's wasting a lot of these people's time. And of course, if the bank contacts you and says, I think what you're doing is suspicious, are you engaged in criminal activity? At least I would not take that very well. And so it's also not good for customer relations. So it has sort of broad implications, both monetarily for banks and also in terms of just annoying a lot of people, invading privacy. If the bank starts saying, why did you move this money from here to here? I in most cases, would like to keep that private, not have to go into detail with some stranger about exactly why that happened. So I'm from IBM. IBM is not a large bank. We make mainframes, we make servers, we do various types of AI software and other things, but banking is actually not our thing. So why am I here from IBM talking about all of this? And a key reason is that 70% of financial transactions around the world still run on IBM mainframes. And this is sort of hidden behind lots of other layers that you never see. But our mainframes basically are the backbone of things, and they have this amazing number of 9s of availability. So there are a handful of seconds of unplanned downtime per year. So that's expensive, but big banks and others pay a lot of money because you don't want it to be the case that the system behind your transaction is down at the moment when you're doing it, which obviously would cause a lot of problems. And similarly, insurance, a lot of it runs on mainframe. So IBM cares because we're sort of inadvertently providing the systems and hardware where a lot of this fraud, crime, et cetera, is done. And for sort of further quantify it, most estimates say there are tens of billions of dollars a year just in the US in terms of things like credit card fraud. There's 40 billion, these are with a B, just in sort of property and casualty insurance fraud, and then there are other types too, like health insurance fraud and others. So we're talking fairly big, important numbers, and if these numbers can be brought down, it's good for the banks, but it also hopefully if brings costs down for consumers, your bank fees, your insurance costs, et cetera. Hopefully that they share some of the goodness if they can improve that sort of situation. So as IBM, we want our customers to be able to run good AI models on mainframes and make the situation better. But as IBM, we face the same problems I was just outlining about lack of availability of data and models. The banks aren't sharing their data. They also don't share models, and they don't share models for a lot of the same reason as data, privacy concern, competitive advantage. But for models also, they don't want to tell the bad guys who are doing all this crime, here's exactly how we detect what you're doing. It's probably not a good way to keep ahead of them. So as IBM, we don't have models. So instead, we've got this whole chain outlined at the very bottom of the slide here. We get good data. We can then sort of have a lot of clever people figure out what we think would be an appropriate model in terms of how many parameters does it have, I mean, what is the actual structure and underlying technology. And then we can design accelerators on our mainframes, and as well as the memory system and CPUs and all the rest of it, so that we can efficiently process this. I mean, so IBM's bread and butter is to build sort of equivalent of GPUs, but for this sort of thing, as opposed to image recognition or the text generation. We do that too, but this is really a huge part of IBM's business. So I've been talking sort of motivation and why we're doing this. So let me get into make this a little bit more concrete. So just in terms of the data we've got, I've hinted at a little bit of this, but there's a broad set from people's names, date of birth, social security number, all the sort of stuff you see here. So from, again, good stuff to bad stuff, and certainly almost all stuff that you wouldn't really, if this were real data, want exposed to the broader world: your driver's license number, your yearly income, if you have any arson convictions, which thankfully very few people do, but there are some. So people normally want to keep this private, and so, but our data provides all of this and actually quite a bit more. In terms of like the credit card transactions I was talking about, here's a sample of this. Probably if you get a monthly credit card statement, looks fairly similar. But the interesting part is probably less the similarities in terms of spending so much on this date and the merchant where you at which you made the purchase. But it's other sorts of stuff like location information. So, for example, our data includes for brick and mortar purchases. We provide latitude and longitude information of the merchant, and that helps with sort of obvious thing. If you're making a purchase now and 5 minutes later you're at another latitude and longitude that's hundreds of miles away, that's probably suspicious. And so this is actually the sort of thing that's behind the covers in real data, and we provided as well. We also, of course, provide a binary fraud indicator, but maybe more importantly than that, we provide the ID of the fraud of the entity that's behind the fraud. And so the way we do this, and I'll get into more detail, but there are lots of entities committing this fraud. They've each got their own particular patterns of doing it. Some steal more, some steal less, some are focused on this geographic area, some on another, some spend on jewelry, some spend it on travel. So there's just like people and there's a lot of variety among the criminals. And so it may be that you've developed an AI model and it's doing pretty well and you've got an F1 score maybe up in the 90s, but there are some cases that are missing. So if you have the fraudster ID, it's sort of the explainability angle. It lets you say, okay, this is the entity where I'm really having trouble, so let me focus in on that. If you have real data, it's almost never actually tagged with who the entity behind the fraud is. It's just the binary indicator. So this is a place where we think our data definitely has a superior power. Let me just point out one other thing. The leftmost column here where it says user and there's this label 1510, I talked about referential integrity back near the start. And so this is an example of how we do that. So this user is 1510. And now we look at financial accounts as opposed to credit card transactions. And we can see, again, we have user 1510 in the middle in row E there. And we can see just to the right of that, this corresponding to 1510 is this person named Elena Castillo. And again, I want to emphasize Elena is a completely fictitious person made up out of whole cloth, not some anonymized person. So I'm not giving away any secrets about a real person here. And so this view of financial accounts gives a sense of sort of Elena's financial position. I mean, we have a lot more detail in terms of amounts in these accounts and the transactions and so forth that go on, but you can see she's got stuff at lots of major banks and brokerages. And I should also say, just these are big name banks and brokerages on the left, but we also model mom and pop, local credit unions, local banks. So we model far more than just big names that you may well have heard of already. And so then you get sort of banking transfers. And again, the boring part is probably this stuff that you see like on your bank statement or your receipts or what have you about moving money from place A to place B, or doing a P2P with Venmo or Zelle, excuse me. But the more interesting stuff, I think, is the labels that we've got it right. And so we have a broad set of labels about each of these transactions. I mean, is there laundering going on? If so, what type? And there are various types that I won't go into detail here. Is there APP fraud, which is a fancy word for scams? Authorized push payment is what it stands for. Is there check fraud? And you may think checks are really on the way out. Why is check fraud an issue? But it actually is a growing issue. Banks are getting more and more concerned about it. And it's actually because of success with credit card fraud as the anti-fraud technology has gotten better with credit cards. The low-hanging fruit has surprisingly gotten to be check fraud. So even though they're, I think, less than a quarter of the number of checks written as there were 25 years ago, the amount of check fraud is really increasing significantly. So banks, not surprisingly, want to identify this. Another thing we provide in the data is not sort of criminally related. It's the reason for the transfer. So is this person paying an electric bill? Are they reimbursing a friend for dinner? Are they buying gas for their car or EV charging or something like that? So we have over 100 different reasons. And a bank or somebody looking at this data might be able to infer that. But again, there's some level of guessing. We provide authoritative information. And if you want a model to sort of understand that, it may be useful to train on synthetic data where you actually have the ground truth of why people are making all of these transfers. I know this is sort of an eye chart. I don't really expect you to read it all, but I wanted to put all this GORP up here just to give a sense that we actually do have a lot of fields, and this is not the largest of it. So in green at left is so this is a homeowner's insurance application. So the left part in green is information about the person, when they were born, the sort of stuff I've already shown, where they live, if they haven't lived at this address for a very long time, where did they live previously, who's their employer, all of that sort of stuff. And then on the right in gray is a lot of information about the house being insured. So everything from number of bedrooms to square feet to heating and electrical updates to less common things like, does it have polybutylene pipes? Does it have asbestos if it's an older house, that sort of thing? Was it converted to a private home from another use? So we built this by, as those things may suggest, by looking very closely at what insurance companies actually care about. And so we've got a very detailed set of information about people, about the house. And of course, insurance companies are underwriting a policy. They want to price it so that it's attractive to you, and they hope to make a profit. And so they need to understand the risk, both from you personally and from the house they're insuring. And so they need all of this sort of information. And so we provide it in our data, and we hope in a realistic way. And by the way, I'll talk in a little bit. I keep talking about realism. I will show some evidence of both how we try to engineer it to have realism and that it actually does have, it is realistic. And so then, of course, as I mentioned before, you've got an insurance policy because, unfortunately, occasionally you may well have to file a claim. So we have over 500 sort of attributes here. When people file claims, everything from, you can sort of see at the bottom, is it from a hurricane or earthquake or volcano? How much is the overall claim amount? And then there are lots of columns, most of which are, of course, not shown here, but a lot of them deal with fraud. And first of all, just is there fraud at all on the claim? And then very detailed, nuanced information about the fraud. And there are different types of fraud. Did you collude with the repair place to inflate the bill? Did you intentionally inflict the damage? There are 7 or 8 different sorts of things. We label them. And then we also say, what type of damage is there? I mean, do you have, was your roof damaged? Did you have stuff stolen? Is there fire damage? We have all sorts of stuff. And then the results of that. So it's a very detailed sort of analysis, sort of database style, which is how insurance companies have traditionally managed this sort of information. But of course, it's something like an insurance claim is rarely quite so cut and dry that you can just list out a bunch of columns and say this completely describes everything that needs to be said. So we also have free text about insurance claims, and this free text is constructed to match the tabular information that we saw on the previous slide. So it would be really, this is an obvious case where using LLMs would be a useful technology, and I think that's something we need to dig into more, but we've really focused on avoiding hallucinations, and I'll get into the details of that. So for this, we're not using LLMs, but we do make sure that the information, the textual information matches the tabular information that we saw. And by understanding the sort of semantic content of this text, it also, I think, provides useful information, like say you're running a call center, and one of the things you want to know is somebody calling in with some routine thing that you can just answer automatically, or is it something you really need a person and you're going to run the person around to 5 different people and take a long time and upset them? And so we can label that sort of thing. I think, again, things like LLMs are getting increasingly good at that, but I think there are some things, there's an example here, how soon will you pay me? Maybe at some point that will be fully automated, but to really answer that question, if somebody wants to know, like, is the check in the mail, so to speak, you've got to look into the payment systems. Is the payment been authorized? Is it gone out? And internally to an insurance company, this involves a lot of processes, and they're unfortunately not, in most cases, really all tied together. So to answer a question like that, you often actually want to get a person on the line who can then ping all of the appropriate people and get an answer about it. So we think this data can be useful not only for things like helping improve the crime situation, but also things like this, maybe hopefully improving the customer experience. So I've been talking a lot about what we've got and what we think it's good for. So how do we do all of this without real data and so forth? Well, the bottom line, as some of you may already have guessed, is an agent-based virtual world model. And so I'll get into more detail about exactly how we do that, but we calibrate these agents like people, companies, criminals with lots and lots of publicly available data. All of you could conceptually go out and start doing this as well. It's not, we don't have private sort of information here. So again, this avoids the sort of PII and other sort of difficulties. And so this information comes from places like the US Census Bureau, which has extremely detailed information on people, not just like how old you are and where you live, but how many cars in a household, what type of roofs are common in a particular area, lots and lots of information. Of course, things like income, age, demographics, lots and lots of things. And so there are, I'd say, on the order of 1,000 sort of attributes here that we pick up and use. And again, these attributes are distributions. They're not saying, I, Erik Altman, have a particular attribute. It's saying down to the zip code level, basically, here's the distributions of a lot of interesting characteristics for a zip code. And so we start with that, and we hope that gives us a good basis and realism that we instantiate our fake people by sampling from this distribution. And companies are similar. We have things like 10K information. We have other sort of marketing information, so we know how big various markets are for groceries or for hair care or for clothes and various other things. So we can sort of divide markets up in terms of people spend and so forth. And I'll get into a little more detail on all of that. But we try to start with good, solid data to begin with. But that said, and I'll get into the problems, there are all sorts of, you don't have 100% complete data, all the sort of correlations that you need to make this stuff make sense, for example, or even just more simple means and variances. I mean, if people are buying tea, how much of that is bought at a grocery store versus a big warehouse store versus online versus other sorts of things. And so some of these things we really have to make our best guess, and then, as I'll describe, sort of iterate to find what seems to be a good solution if the data we're generating doesn't seem to match published numbers that are available. So how do we do this more specifically? We start out with this entity graph, and this is, of course, a very simplified example, but say you start with this person box in green towards the lower bottom middle. And so this person has a bank account. They also shop at some particular retail company. That retail company also has a bank account. The person also owns stock. The stock turns out to be in the supplier of the employer of person. And the employer has another supplier, supplier one. So you can sort of see we build up this recursive graph of the world and how everything sort of interconnects. And so we start this statically, but there are the dynamic connections that get made. So there are a lot of sort of brokerage problems here. I mean, so how do you decide who is the employer of person? There are lots of companies out there, but if you're all here living in Palo Alto, it's unlikely your employer is a barber shop in Minneapolis. So we've got lots of sort of brokerage sort of issues to make appropriate matches between all of these different things and how they should interconnect. Some of that is sort of static, i.e. before you start this virtual world running, and some of it is dynamic that you determine once it is running. And so then, just to get into a little more detail about some of the stuff I've already been saying, we take all of this information, like from the U.S. Census Bureau, to instantiate a U.S. population. We're looking at doing this for other countries, and we're sort of in the midst of several other countries as well, but it's a similar sort of proposition. It's sort of easy to say you get all this data and then you create synthetic people, but there's actually a lot of work to get stuff in appropriate formats, the usual data wrangling and other sorts of issues. But the same principle applies everywhere. Although we base people in the US, we don't sort of limit people to being in the US. So people travel all over the world, both for business and pleasure. They make business deals in other places. They do banking is needed for those other sort of activities. So we want people to be able to go everywhere. And so we have transactions denominated, and I think there are 144 different currencies around the world. So we model all of those. And also, I should say, 10 of the largest cryptocurrencies are also included in what we're generating. And so we have more than 32 million merchants worldwide. And it's important to have that many because we're building a large virtual population. We never know where they're going to go, so you've got to have merchants to serve them wherever they go. And even with so much online shopping and so forth now, the majority, like 80% of say retail activity, is still at brick and mortar. So if we're going to be putting people down all over, and so we need them to have jobs, to have places to shop, and so forth, no matter where they are. And so that ends up generating a lot of companies and a lot of company locations. At the bottom, so everybody has their own particular preferences. Maybe I like to take vacations, and you like to buy jewelry or nice clothes. So there's a broad variety, but there are some things that are more common across people. So older people, we're talking distributionally, of course, there are exceptions to all of this stuff, tend to have a somewhat different distribution of spending than, say, people who are in their 20s. Likewise, people who have a lot of money tend to spend differently than poorer people. Although, again, we have frugal, rich people, and we have people who have less income but really want to live life to the fullest and spend as much as they can. And of course, things are different if you're at home or you're traveling, and the type of travel really matters. So we model all of that. weekend versus weekday matters. And of course, so does hour of the day. You might buy coffee in the morning as you're coming into school here. But maybe in the evening, you're at a bar or you're out for entertainment. And so again, we have taken a lot of care to model all of these things as accurately as we can. That said, of course, there's inevitably lots of room for improvement. Yeah, just to emphasize the sort of realism point. And so we distribute people by zip code, and one of the key things is population. So we have more people in New York City, say, than we have in rural Kansas, because that's actually true. And of course, the demographics in terms of spending, in terms of the type of house or apartment people live is also different in those places. And again, we model all of those sorts of things so that we have sort of a realistic sort of behavior. We also model as national merchants, like say McDonald's versus your local diner, and we try and apportion things appropriately based on say 10K filings. So how much of the fast food pie, so to speak, is taken by McDonald's and how much is taken by local diners. And again, that gets to the brokerage problem. If somebody's going out, do they go to McDonald's or do they go to the local diner? And the brokerage problem there has other sorts of things. If you've been to a place before, you're more likely to do it again. Is there any place nearby that's what you're looking for? And so, or do you buy it online? So again, lots of detail. So in terms of realism, how well does this actually work? We're lucky enough to work with a large card provider at one point in all of this work. And they never showed us any of their real data, just like the problem I was complaining about at the start, but they did give us some histograms like this one. And so this is showing transaction amounts versus relative frequency. And you can see the blue and the yellow here line up almost exactly. They showed us several other things like seasonality. Spending is somewhat different in December, say, than in July. There are also things like what are called merchant category codes, which is how much are you spending on hair care versus fast food versus vacations. And so again, they gave us a whole set of histograms. They weren't all quite this good, but most of them were pretty good and were along these lines. So this gave us a lot of confidence that we were on the right track. And I must say this particular graph and the others, we didn't get to iterate with them, like say, okay, now we've seen how we differ from real. This is just out of the blocks using the sort of basic information and approach that I said. We were able to hit things fairly closely. So I think, obviously, we're happy that it worked out that way for us, but I think it speaks more broadly to that if you approach this with sort of focus and understanding of the sort of the problem domain, you can often do quite well. Okay, so in terms of how we instantiate this, I've been focused mostly on sort of legitimate activity. I mean, people buying things legitimately or being employed legitimately. Of course, there's a whole population of criminals, and that includes things, smugglers, child traffickers, all this bad stuff, people committing extortion. So we model, unfortunately, a wide variety of that sort of criminal activity, how much criminals get from it. And just like the rest of the population, these criminal entities, and sometimes it could be one person, sometimes it could be a whole collection, they've all got their own attributes, again, in terms of the frequency of their operation, what they specialize in, where they do it, the times over which they're active, and so forth. And of course, then how they maybe try and launder their ill-gotten money. So again, we do very detailed modeling of criminals, and part of that is to make sure we get sort of the right level of criminality, and part of it is to make sure we have sort of the right distribution. And that's actually very important, because even though I was suggesting it's very important to be realistic, we think it's also very important to be, in some cases, to have flexibility. And so the criminality aspect is one part of that. And so the criminality, which is what I mean here by minority class, is very skewed. So for things like money laundering, maybe 1 in 1,000 or 1 in 2,000 or even less transactions involves money laundering. Well, that makes it very hard for an AI model to separate out the bad money laundering stuff from the real stuff. And so it makes it hard to train accurate models. So a lot of people have found across a whole range of domains, not just the stuff I'm talking about here, that it can help to amplify the minority class through techniques like SMOTE. And of course, there's goodness in that, but we think the way we're doing stuff actually allows a nicer sort of amplification. So we can increase the number of criminals, and because they're also varied, this keeps the diversity that you might lose in SMOTE. If you just have in your underlying sample a handful of criminal actors, you're sort of amplifying stuff in a particular way when that's not really what would happen if you had sort of full data or enlarged data. We can amplify the number of criminals, or we can also increase the rate at which they do their activities, steal credit cards or do other things. So we can really naturally amplify things. And we've looked at how this works in models, and it definitely improves the accuracy to train basically on data with a lot of criminality in it, and then run it on for inferencing on data which has a normal, much lower amount of criminality. So just in case it's unclear, because in some presentations this has caused confusion. So I keep talking about 100% accuracy. So because of this agent-based virtual world, we know who all the criminals are. We know whenever they do something bad and extort money, and then where they put it, whether that's cash or whether that's a bank account or whatever the case may be. So because we're in charge of this virtual world, we really know everything that's going on in it. So we can make this, so we do have this 100% accuracy. That's, of course, very different than a model that's, say, looking at this data or some other data and trying to infer all of these things. That, of course, is virtually impossible to get anywhere near 100% accuracy. So we're not claiming models with 100% accuracy. We're only claiming the data is properly labeled with 100% at the time. And of course, that's I think an important distinction. Just to go into a little bit more detail then, or example of a model. So here's again at the top a table with some banking transactions, and the focus here is money laundering. And so a natural thing to do is to convert this table into a more graph-like representation that you see at lower right there, where you see the nodes are quite naturally the different accounts, and then the edges are transactions between those accounts, and there are decorations on these nodes and edges, things like dates, how much money is transferred, how frequently are various amounts of money transferred. So there are a lot of decorations you can put on these edges to try and better understand essentially what are the graph patterns that are unusual for that are unusual among legitimate activity, but maybe more common among money laundering. And so that's exactly what you got here. These three transactions highlighted in red at the top form a cycle at the sort of upper left of the graph. And so, of course, legitimate transactions can have cycles, but it's more common in illegitimate. So this at least raises some level of suspicion that things may be happening. And of course, I'm showing the sort of almost minimal cycle. These cycles can get much longer, involve many more accounts, go over a long period of time. So this gets to be quite a challenging problem to tease out what are the problematic patterns. And of course, cycles are not the only thing that happen. It's probably a little too small to read, but you can see fan-ins and scatter, gather, and scatter, gather, gather, scatter. So there are lots of different patterns that you can sort of look for in this data. But again, of course, these patterns can appear in legitimate. So you want to, again, look at some of these decorations and understand with the auxiliary data what is most typical of money laundering. And we've published papers on this, and it really, we found a significant improvement over past work by using both this data and then using these sort of techniques. And just to amplify on that a little bit, that's actually the work I was just talking about is something called graph feature preprocessor. So it looks at these graph features, but it's at some level naive. It looks for things like cycles or scatter gather and says maybe that's more suspicious, at least under some circumstances. Fraud GT sort of builds on that, and it uses the attention mechanism to say, well, these are the patterns you should really hone in on. And so just like with the large language models, it figures out sort of organically what is the interesting feature to look for, and so its accuracy is even higher. But of course, its runtime overhead is also a bit higher. So in all of these things, there's a little bit of a trade-off. Can you do this at real time with sort of a reasonable amount of memory and compute? Or do you have lower accuracy? And I think we're still on the learning curve, and there's lots of room for improvement in this space. And one of the things I'm hoping is that all of these things improve a lot over time. By the way, I would also say that about our data. We've obviously put a lot of, or I hope it's obvious, we put a lot of work into our data, but we think that it would be good actually if there were other data around as well, because it's going to have, our data certainly has its own biases and skews and so forth. If there's other data out there and you're training a model, if you train on both, you're almost certainly going to have a more robust, effective model than if you're just training on one thing. So I would say the more the merrier. So these are all open source models. The QR codes are there. So there are also things like old-fashioned LSTM models for credit card fraud detection. And I must say things like gradient boosted trees, LSTM actually work very well for credit card fraud detection. There's a transformer-based model called Tabformer, also for credit card fraud detection. And again, these all, I think, are very interesting approaches. But again, I think sort of early days of some of this sort of stuff. Okay, so we're hardly the only ones doing synthetic data these days. The slide's a couple of years old, but it was all the companies somebody found in the space at that point, and I think there were 97 of them. Most of them are startups, but there's some big players like NVIDIA that you see at the bottom here. And in fact, you may have noticed that NVIDIA bought Gretel in March for $320 million. So it's definitely an active space sort of at all levels. And SAS acquired Hazy, which is another significant startup here last November for an undisclosed amount. So this is an active space, both in terms of technical development and in terms of mergers, acquisitions, that sort of thing. So because it's this, so there are 97 or more different places with just companies, let alone academic sort of work, doing synthetic data. So is what I'm saying any different than any of the rest? And you're probably not surprised to say that I think there are differences. So we don't require any real seed data. I've talked about, we have these distributions. We're not taking real data and anonymizing it or otherwise changing it. Most of these other things require real seed data. Some of them will say we support agent-based sort of approaches, but that tends to mean they provide a nice platform on which you can build an agent-based approach. But it's a lot of work to put together all of the realism and connections that I've described here. I mean, just to give some indication of that, the current code base that we've got for the data generator that I've been talking about here is more than 350,000 lines of code. It's taken several years to develop. It requires going in and understanding spaces like insurance and banking and so forth. So this is not just a trivial effort. I mean, if one of you wants to prove me wrong and next weekend you're emailing me that you can do all this and more, I'd be very interested to hear how you did it. But one of the nice things is it then means low user effort. I mean, we tend to distribute this data as things like CSVs, so you can just immediately start going with whatever model you think is best. As I've said, there are no privacy issues because everything is sort of constructed about fake people, et cetera, fake criminals. The fields are consistent and realistic, and I'll talk about that a little bit more in a minute, why that can be hard with other approaches. And of course, the ground truth is always known. Of course, you would think I was being too much of a marketing person, maybe you already do, if I said there was nothing wrong. Our method is the best that could ever be in every dimension. And obviously where we're not as good is it's a very focused sort of approach. This is a financial data. Other approaches like LLM-based approaches can generate a really broad set of data and in many cases do a really good job of it. We cannot do that. It takes a lot of work to do this sort of thing. But that said, I mean, just to give ourselves a little bit of credit, one of the things we do not currently generate is tax data, like say US Form 1040s that many of you may file. We don't do that, but because of all the other sort of data that you've seen that we're generating here, income data, bank interest, dividends, capital gains. We model all of that. So I actually don't think it's basically just dumping out in another format than what we have, information that's already there. And I think at some point in a lot of these domains, you sort of reach it's not that you never need to add more features, but you can sort of have stuff that you just need to dump in a different format. And I think in the sort of financial domain, I hope we're at least close in that regard. As I've said, you could use LLMs, but they have two fundamental problems, the sort of two sub-bullets here. Real data is often not available. I'm talking about in the financial domain. So you can't really take real data and create nice new stuff. And it's got a lot of shortcomings and errors. And I'll get into that in more detail in a minute. But those shortcomings really make for a sort of garbage in, garbage out sort of situation, I think, if you were actually able to access it and use it. And so just to give a couple of examples of that, if you have transactions like in blue there, and at 12:25 p.m. on April 25th, you're making a purchase at H&M in Boston, and then 15 minutes later, you're at a McDonald's in Palo Alto, there's probably something suspicious going on. I'm assuming same card, supposedly of the same person. This is an obvious example, but if you're generating data with LLMs, it's very easy to get this sort of situation because there are just so many cross correlations. It's hard to know exactly what's important. And some implementations do better than others, but this is a really problematic thing that we found. And just to make that maybe a little bit more visceral, this is data from an LLM style generator. I won't say exactly which one, but all the pink sort of suggests it's loaded with errors. So it's got, say, zip codes that don't match the city. Like it says the zip code for Los Angeles is 02215. As you may or may not be aware, like the rest of California, I think the numbers are up and start with a 9, not a 0. It shows New Orleans as being in Italy. Credit card numbers, a lot of them have 4-digit CVVs, not 3. It shows the state of Michigan in the US being in France. It shows card expiration dates in the 1970s. And again, it's just because if you don't have a semantic understanding of the data, it can be really hard to know what features you should be matching exactly. And this is very, I think, feature rich in maybe subtle sort of ways. I'm not saying this can never be solved, but I don't think it's solved fully now. I think another sort of interesting direction that this approach may help with is model collapse. And so I've mentioned a lot of the entities, people, companies, criminals, we have a very large, they're based on a large number of distributions. They're not all independent, but still on the order of 1,000 distributions. And if you say from those 1,000 distributions, say it's normally distributed, you might get 20 realistic values. Well, 1,000 to the 20th is 10 to the 60th. So that's a lot of room to play with sort of different spaces, different things that could happen. And so maybe this helps with the model collapse sort of thing. And those numbers are really just the sort of static attributes that we assign to these different entities. The running the virtual world then generates a lot of additional stochastic behavior. I mean, does this person travel to another city today? That's a stochastic sort of thing. And so the state space expands even more. So I think, of course, not all of the space is interesting, but I think it provides one way that may potentially help, at least to some degree, with things like model collapse. And so whether or not I'm correct about model collapse, I think is actually one open research challenge, and whether this sort of thing might actually help. A few others is this sort of calibration stuff. I mean, and so we start with these micro parameters. I mean, here, this person likes to spend on these attributes or these categories and not on these others. This person pays their bills on time. This person doesn't. That sort of thing. So we have these sort of distributions and inputs, and we get these outputs, and there's reporting on a lot of the macro level, like this percentage of the population is behind in their credit card bill. So we can see if that matches. But with what we've done to date, it's a lot of manual effort to go back and because on the first try, things definitely do not match. The macro numbers do not look like what they should have. So we go back and say, well, maybe we should tweak this, but because all of these distributions are not independent, other things change. So it's a lot of manual effort. And I think one of the things is there's some variation of back propagation that could be used here. So you start with the output parameters and you back propagate and update the inputs, just like what we do with stochastic gradient descent all over the place. Could something like that be done for these sort of agent-based models? Or maybe somebody's already done that if the literature is large, and I cannot claim to really be on top of everything. So if somebody wants to tell me that's a solved problem, I'm delighted to hear it. Another problem is sort of nonlinearities. We do not just, so the United States has on the order of 340 million people. We don't just instantiate when we're generating data, 340 million people, however many companies there are, for sort of two reasons. We want flexibility, and of course, it's computationally expensive to do everything at sort of full population level scale. So we want to scale things down, but that of course introduces nonlinearities. And to maybe make that more viscerally clear, say we scale down to just one person. Well, that one person probably still needs a job, they still need to eat, they still need clothes, they still need to pay their bills, all that sort of stuff. So then there are all these companies that they have to interact with. So you're not really scaling down companies necessarily to the same degree you're scaling down people. And of course, if there's only one person, the revenue for these companies is very low, so that's unrealistic. So again, there's a lot of, when we scale down populations, there are a lot of problems that have to be solved, and what we've done up to now is really a lot of sort of manual tweaking and sort of human intuition. I think we should have reduced this if we're reducing that. I think that's the sort of thing that could be automated to good effect. And in terms of that sort of automation, there's another, I think, key component, and that is things like what-if scenarios or counterfactuals. It's very important, I think, to understand the world, not just as it is right now or as it was 5 years ago or whatever the case may be, but as it might evolve. That can potentially let, if you're interested in stopping criminality, maybe you get ahead of the criminals by guessing, well, maybe this is what they're going to try next. Or maybe you say, obviously there are a lot of trade issues going on these days. Well, I think the world's going to evolve this way, and that will affect finances this way. Right now, you've only got existing data to sort of estimate the impact of that. I mean, if you can come up with these counterfactuals or what ifs, you can then generate data for those sort of situations and see how well your models respond to them. And hopefully, if you're building these models, get ahead of the situation. So that's pretty obvious. You just follow the 4 steps up there, A through D, generate the data, run a model and make predictions like, is something fraudulent? The fraudster then figures out that they're being caught with that particular pattern, they change it. So then you want to generate new data to reflect that change, and you keep iterating like that. And so that, I think, then also brings up several questions. Does this sequence reach a fixed point? I mean, do you eventually get a model which catches all fraud, or at least all fraud of a particular type? I don't know. I think it's an interesting question. I mean, maybe it's an infinite chaotic sequence, an arms race that never ends. So I think both sort of practical and theoretical sort of interesting things there. A bad thing is if fraudsters, criminals could obviously embrace this sort of approach too, and basically try and get ahead of the bank models or insurance models or whatever the case may be, so that they're less likely to be caught. I mean, obviously, I hope that doesn't happen, but it's, I think, especially with state level actors, it's something I think to be concerned about. And with luck, we end up with something like with encryption protocols where figure out public key encryption or quantum safe algorithms and get ahead, and everybody can see that they're robust and resilient. But I certainly don't know the answers to those things yet, and I think they're all worthy of exploration. Another thing I think is consistency of published findings. That may be more in a situation which I think HAI is more involved than we've been, and things like health situations. I mean, there are so many health variables, far more than I think financial variables. And so if you're doing a health or medical study, you can't sort of run every variable in every single study. It's just not feasible. So for example, I doubt there are studies that compare gangrene versus blood pressure versus migraine versus osteoporosis. That'd be a sort of unusual combination, I think. But what you could do, I think, with synthetic data is you sort of build the synthetic health population as best you can, and then you can compare and look where your synthetic agent-based approach is yielding discrepancies compared to the real data. So maybe you're just missing something in how you've calibrated the synthetic data, but maybe the real data, there's actually some problem that needs further investigation, so you can get maybe a deeper understanding of the natural world. So this is not all just about crime and the financial issues. I think the issues expand into other, obviously extremely important problems that we face. So I just sort of alluded to medicine. I know there are other sort of agent-based approaches like big stock firms do in terms of modeling trading desks and how they place their orders. But I think the space for employing these sort of techniques is probably much broader still. And I don't really know how to bound it, but I think it's an interesting area. Another interesting thing I think is I've talked about like banks like in the US can only see transactions to which they're a party, but things like money laundering, you really benefit from a global view. And with the data we generate, you get the global view. So if you have data like we have, the full set of banking transactions everywhere in the world, can you use that to sort of infer global characteristics from local data better than you can do now when everybody's siloed and only sees their local data? We've investigated that a little bit, and it seems to be promising, but I think it's, again, early days, and I think definitely worthy of more study. And of course, there are a lot of areas where I think this could probably complement LLMs and vice versa in ways that we have not yet taken advantage of. And I think that's very interesting to see how those sort of synergies should be developed going forward. So to sort of wrap up here, I hope I'm not beating a dead horse, but I'll just emphasize a few things that we're not, because it's caused confusion before. We're not a magnifier of existing data. Where we sample distributions to create our data, and which is individuals, and then the side effects of simulating them is things like transactions. We're not built using large language models, and what we're producing is not a model. We're not giving you something that predicts this is credit card fraud or money laundering or a scam. What we're providing is data which helps you or somebody else predict whether those problems are occurring, and I think there's a lot of room for improvement, as I've outlined during the talk. And again, I want to, because in some sense, talking about so much crime is a little bit of a downer. I mean, there are better things, loan scoring, which in the positive sense is they realize you're a better credit risk than they thought, and so you get a lower interest rate. Things like insurance, underwriting, marketing. I think there are a lot of sort of uses for this data. And just as an example, we built this data for all the sort of reasons I've indicated, but somebody in IBM was interested in analogies. And so they said, what are all the transactions that are like Easy Pass on the US East Coast? And for those of you who are not familiar, Easy Pass is the automated highway tolling system on the US East Coast. And it actually came back and said things like Fast Track in California, TX Tag in Texas, SunPass in Florida. So we did not build this so that somebody could run those sort of analogy queries. But what I'm saying is I think if you do a robust job building this sort of agent-based approach, you don't necessarily have to be limited to the use cases you were thinking about when you started it. And in terms of, since I'm from IBM, who might want to use this besides academia? Well, large businesses who have all the real data problems that I've mentioned, startups, fintechs, and maybe you've got a brilliant idea how to address some of these, but you don't have real data. Well, we don't have real data, but we think we've got pretty high quality synthetic data. Or another thing is, regulatory agencies like that control insurance want to make sure people are being treated fairly, want to make sure models are sort of accurate as they can be. Well, this sort of data, like many other things, could be used as a benchmark and without compromising all the PII and privacy sort of problems that could occur if they were to try and do this with real data. So that's what I've got. Again, thank you all for coming and listening. I'm happy to take questions.
Thank you. This is very impressive. And I'm an economist, and this virtual model that you're describing, this interconnected world, resembles quite a bit the efforts of economists to build these general equilibrium models. And there, one of the biggest challenges is to describe the formation of prices and how supply and demands finds an equilibrium. How do you deal with that? Is that at all? But I guess it's supposed to be something that it's a problem that you should face. So I'm trying to help me thinking about that. How do you deal with that problem?
So pricing, we more or less take as given. So we have a distribution of prices. Like if you're going to the grocery store and you have this much income and your previous grocery shopping has had a bill of $150, then we're going to center you around 150, but we're going to have exceptions. So I think that general equilibrium pricing is a very hard problem. I mean, people like Adam Smith tried to deal with that. They dared to deal with it in the 19th century. I mean, so that's too hard a problem that we haven't tried to take on here. But I know I mentioned people are doing things like doing stock trade orders, and so that very much is a pricing problem. They're trying to figure out what's the right sequencing to do this. I'm not an expert on that, but I think they've actually used it to fairly good effect. And if you're not familiar with it, there's a conference, ICAFE, International Conference on AI and Finance, which has a lot of papers on this sort of issue. So I wish I could give you a technical answer. I hope what we've shown is that this framework can be attractive, but I don't know how the equilibrium pricing is going to come out. Or, I mean, actually, I mentioned, do we reach a fixed point, or is this a sort of chaotic situation? And do you think there is a general equilibrium for prices, or that it's a chaotic?
I think there's supposed to be one, right?
I was just wondering whether your model can be used to possibly predict a risk, let's say a stress test in the banking system, or maybe a black swan event, things like that. Is it possible, you think?
Yes, I do. So a lot of the distributions we have, so some of them are normally distributed, but a lot of them end up basically being histograms. And so just like with a normal distribution, the tails of this histogram tend to be unusual events. And if you have 1,000 of them, a black swan event is if you get to say the least likely event in all of these 1,000 distributions. So I absolutely think you could get, it would be very interesting to do black swan events, and you might need to, one of the sort of practical problems we face is you can generate an enormous amount of data this way, and it actually comes out fairly efficiently. So you need the storage and so forth to support it. But I think that would be a really interesting thing to explore.
Really eager. A couple of weeks ago, maybe a couple of months ago, we had a talk with somebody trying to read the mammograms and data from the medicine. And the problem was that all of that were private. I was wondering, is there anything, say, imaging normally distributed in a way that it's accessible to you so you can make a model?
You said for mammograms?
I'm talking about the general medical images that are not actually, 90% of them are not available, just like transactions.
Right. Yes.
So is there anything that you can do for them? I mean, that means, are there probability distributions of those data available?
So I'm definitely not a medical doctor, although early on when we were doing this, we did look at the medical field and basically gave up because it seemed so hard and the cross correlations seemed even harder than here. But I suspect if you got a radiologist and somebody who knew how to read these things and you sort of worked with them, they could probably give you distributions. Here are the unusual things, and here are the 20 key characteristics. And I would think you could probably generate some pretty interesting mammograms. I think there's a pretty active field. I'm not really up on it in medical imaging, and maybe the speaker you mentioned has more, but I definitely, without being an expert in that area, it sounds appealing to me.
All right, thank you.
Hello, hi. So I basically come from a HCI background, so my question is more towards that, and then it comes to the problem you're trying to tackle with data generation. So in HCI, in human understanding, what I've been working on is it's really difficult to pinpoint the various interactions or various traits that humans exhibit. And when we come to classify those, the biggest question is, let's say, how many classes exist? And my question towards coming from this background, when we're trying to model different distributions or different behaviors that a data set needs to exhibit in order for you and your team and your partners to extract information from it, how do you condense that in a way that it can be useful? Because in the first place, we don't know how many classes exist because there are multiple patterns. And you touched on this in terms of your the graph you showed, that there can be certain cycles, but at the same time, there can be other patterns. And you also touched upon using a smaller scale in terms of, let's say, a smaller company or a bank. But I understand this is a massive question altogether, but how is your team dealing with such a challenge?
So that's a really good question. Actually, all the questions have been. So we have some underlying hidden attributes of people. So one, it's not nearly as sophisticated, I think, as what you would want, but we have like a 0 to 1 variable for every fake person. 0 being your sort of the ultra conservative, safe, you never take any risk. 1 being you take every risk that's ever thrown at you and you just go out there and live a very dangerous life, probably. We also have sort of financial dealings. I mean, are you an ultimate, do you want to live on the edge, or do you want to be very cautious and have insured savings and all the rest? So for the financial domain, we've tried to have a few sort of hidden variables so that people behave consistently, because you don't want, if I'm in one case behaving very cautiously, I'm suddenly behaving very recklessly. And so we've tried to identify a few hidden variables like that don't actually get exposed in any of the data we're reporting. And I would think for what you're doing, that there could be a whole vector of those sort of attributes. I don't know what they are, but I think it's been fairly effective. We looked at what happened as you sort of varied risk profiles. Right now, we just uniformly distributed 0 to 1 for like the example I said. But we've done a little bit of experimentation. I think it would be worth doing more to play with those variables and have more of